Okay, recording is on. We are ready to get started. And thank you again for showing. And I hope you enjoyed the short break. My name is Beit-Or, and I've learned from my mistakes by not always talking about myself. So I just want to say briefly, I've been an investor for almost 10 years now, since 2002. I started investing when I used to live in Tel Aviv in Israel, in the United States. I moved to the United States in 2004, and since 2004, what I do is I build my own portfolio, enjoy the big boom ride to the top, and had suffered some of the crash. It did not skip me as well, but I love real estate. I do it day in, day out. Most of what I do is either work for my own portfolio or help investors invest in real estate. I don't have a high-tech job. I don't work for a big corporation. I work for a huge corporation, mine. That's the business I'm in, the Danny's business, and I love it. You'll see probably from my speaking, I enjoy this. I have had well over 6,000 one-on-one strategy sessions with investors over the years. And when I have to say this number, 6,000, not everybody ended up investing, but I had a lot of those meetings. You do pick up a thing or two, and the way I know I'm in the right position for myself is when someone calls me, let's say tomorrow, and wants to have this type of a meeting, I come as fresh as I was when I had my first meeting, and I do remember my first meeting as well. And I come, when I see that I'm fresh and I enjoy it and I get passionate about it, that tells me I'm in the right spot for myself. So tonight is probably some sort of a kind of combination of, you can almost call it, maybe you should have called it not accelerating your financial independence, but a little bit the confession of a real estate investor, or a little bit longer term real estate investor. I can't say longer too much, because next to the 20, 30, 40 years investors that I know, I feel a child and still learning. But this is actually bringing a lot of those things, a lot of my experience together, and kind of narrowing it, putting it together. Now, the style of the presentation is interrupt, ask, and so on. Don't wait for the end for questions unless you want to. I may ask you to hold on with the question and write it down and ask it at the end, just because it will take me too much of a sidetrack, or I may answer it on the spot. Please do not get offended if I say let's wait for a little bit later. Maybe I'm going to touch on it, or maybe I actually think it's better if we leave it to the end. Okay, so feel free to ask questions as we move along. By the way, this type of a presentation, I do need your attention. The reason is, it's a little bit of a puzzle. I'm going to talk about several pieces, and towards the end, I'm going to bring those pieces together. So things may not be clear at all times, and mostly how everything is tied together, but you'll see at the end, I'm bringing it all together. But it's also important that when I move forward, that you understand some of the basics, in order to kind of go to the next level or next step. Disclaimer always, just practice safe investing. Make sure you use professionals to help you. Don't just take everything I'm saying or any speaker and try to apply it immediately if you don't have the skills, the tools, the experience. And seek advice, for those who have those skills and experience and knowledge, myself or someone else for that matter. Another social media warning. Please, 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 pull up your smartphone, iPads, or whatever you want to call them, take photos of me, put it on Facebook, put it on Twitter. It will do me a lot of fun and enjoying to see that. So feel free to use your social media in order to promote my name, my DBA, which is Simply Do It, whatever you want to do, that's completely fine, okay? So anyone needs help with, doing that? Okay, good, I'm glad.
I don't have a Facebook account.
So it's you.
That's right.
They're down the street, they're going to come after you. I'm sure you have Twitter and Google+.
I don't have any of those.
Okay, very good. You guys ready? Everybody set? Perfect. Okay. So I want to start by a sentence that I hear many, many times. Maybe not exactly like this one, but a lot. Actually, there are people in this room who told me this sentence. I think some of them are smiling because they recognize it, or at least one of them is. it comes in different variations, but it's pretty much the point. And this is what I think I've been hearing the most in the past year. Can everybody see okay? All the way in the back, guys, you okay? I want to have a net income of $10,000, net income of $10,000 every month in 12 years from now. Okay? One of my investors put it even more strongly. When he sat down, the first thing he said, him and his wife sat with me, and he said, in 12 years, I'm dead. I said, what? He said, I'm dead. What do you mean? He said, well, I'm not going to be dead. Hopefully not. I have kids, I don't want to die. But he said, I'm an engineer, I'm 38. An engineer in the age of 50 doesn't really exist in Silicon Valley. Okay? I'm sure many of you understand that. What does it mean? It means that if you're an engineer in Silicon Valley and you get to the age of 50 and you have a job, it's good. I'm sure there are out there those type of engineers at that age and after. I know there are. But a lot of you guys, male and female, know that when you get to that point, if you lose your job for whatever reason, as a Silicon Valley engineer, or can be other industries as well, the chances of you getting another job are getting smaller and smaller all the time. And his second sentence was, I want to make sure at least my income or my wife's income can be supplemented somewhere else. Okay? Then we went on to create a plan how to achieve that. So that is something, if I make it funny, good. That's for enjoyment and entertainment. Is it serious? Absolutely. Because in order to get to that point, if we can get to that point right now, we need time. And we need a plan, and we need to know where we're heading. Because there are things that may prevent us or want to stop us from getting to that point. We're going to talk about that. This is the answer. So if you want a quick answer and not stay to my full presentation and you just want the answer, here is your answer. Have 16 houses, all paid off, in 12 years. Actually it's going to be more than $10,000. Okay, at least the 16 houses that I have in mind. It's going to be more than $10,000, all paid off in 12 years. Okay, so if someone wants the quick, the express route, this is it. You're good night, you're good to go. But let's actually learn how to get to that point, because that's the tricky part. Nice office. Okay, we're going to start with the basics. And then we're going to move on to expedite. So I'm going to spend probably the next 10 minutes or so on the basic, and it's important to understand. It's important that you understand what I'm talking about in order to move on to the next level. Let's talk about a couple of things that are probably trivial, and you probably know them, or heard them, or forgot about them, or whatever, but I want to remind us all of those things. The first thing, what I call the mortgage miracle. What is the mortgage miracle? The mortgage miracle, I should say, the U.S. mortgage miracle. In the United States, and I'm going to lose that for a second. In the United States, when you take a mortgage, okay, let's say $100,000 mortgage, the principal, $100,000, is not indexed. That means it's not pegged to the cost of living. In other words, when things around us go up in price, the proof of that would be stamps, movie tickets, rent, gas, groceries maybe. Okay, when those things go up in price, okay, there's an index, cost of living index. What happens to your mortgage principal? Nothing. Nothing, right? Actually, at the same period of time, it actually gets lower and lower because we're paying it. Okay, so that is what happens in the United States. Not anything new about it. Probably most of you know that. There's nothing new about it. But let's just not take it for granted. How does it work in other countries? Okay? You start at the same point. Cost of living is here. Mortgage of $100,000, same thing. Cost of living went up. Mortgage principal kept up. So, several years later, you started at $100,000, and maybe 4 years later, or 5, whatever, you owe 104. Right? United States, at the same period of time, cost of living went up, and your principal balance went down because you're already paying. You know it's not go beyond that. What does it mean? It's a gift to the borrower. It's an unbelievable gift. So if we think, let's say, if our first assumption is real estate is a good vehicle, investment vehicle. Let's just say for a second, I'm not going to talk about this type of investment, that type of residential, forget it. Just understanding. Right now, the first, the starting position is, let's assume real estate is a good investment vehicle for many reasons I'm going to name. But if we take it, now we're going to start making it a little bit better, optimize the entire idea, concept. The mortgage principle makes it a very attractive because it's not the way it happens in other countries. Next, leverage. Nothing new. We all know that. You put a little down payment relatively, let's call it in this example $20,000, and you take an $80,000 mortgage, right, or so. Nothing new about it. Very trivial. By the way, same thing in other countries, no difference here. But what makes it so special is the following. I don't like to look at it this way. The way I look at it is the following. Trivial stuff, but important to remember. I buy a house, a rental property. I put $20,000 down, and I take a mortgage of $80,000. And I'm renting it out. What happens next? A nice tenant comes in, pays for the expenses, for the mortgage, and in the most cases I'm pocketing a few $100s in my, every month. We call it cash flow. But in reality, think about it. You're borrowing money, someone else is not only paying it, covering the costs, the expenses of the property, and leaving you with cash in cash in your pocket, right? Very trivial, but how sweet of a deal it is. By the way, did I say anything about appreciation? It will go down, will it go up? No, I'm just talking a very simple thing. And I'm not going to go into, are tenants a good thing or bad thing? We're going to get to that later. I just want to make sure we're understanding the benefits of it. Tax benefits. Real estate provides us with tax benefits in some instances. I'm not going to go deep into that because that's a CPA that I hope we're going to have in May talk. But it may even create a situation where we can use real estate to shelter some of our income, active or passive income in some instances. So there's tax benefit to be a real estate investor. Deductions. Everybody's with me? Okay? Deductions. The IRS code, in a way, in simple terms, says this is a business. This is not a house, it's a business. As a business, you have expenses, so you can deduct them. Traveling, interest, property management, insurance, repairs, depreciation, okay? And, probably a few other things as well, fees, etc. You can deduct them out of your income. Actually, so much so that you can actually have at the end of the year a profit and report a loss because of the depreciation in some cases. Okay? What? Profit in the pocket, in the bank, and report a loss? Is it possible? The answer is yes. Okay? Again, I'm not going to go into it because that's out of the scope, but it's just important to understand. Excuse me for the mistake I did here. The side business should have been its own line, and that's actually probably the main component what I'm going to talk about in this part. The way I look at the real estate or the rental properties is as follows. Forget it. Don't call it from now on a rental property. Call it my little side business, my little factory. Okay? What do I mean by that? Let's say we buy a rental property and we put it on the market and we rent it out. In other words, we have a little business. Sorry, maybe I should start by saying this. Over the years, I told you I had more than 6,000 meetings, one-on-one meetings. And one of the patterns I saw that is repeating itself is that the investors come to me and they say, I have my job, and then, my main job, 9 to 5, whatever you want to call it, but then I do some tutoring of math and physics in the evening and weekends to supplement the income. I do website, I do coding, I do this. So it's very typical. I hear a lot of people that are coming to meet with me and saying, this is my job, but, I have other things to supplement the income. One of my friends manages, several retail stores in the city. And that's his business. Actually, it's 5 stores, I think around 50 employees, or maybe 60 employees if you count all the, not just the salesperson. And that's his business. Now he started with his partner, and they're venturing out to a new business, another chain of stores that is going to create, supplement their income. Now, I don't know what's going on in his main business. That's been going on for years. This business, it's a startup in the retail industry, so to speak. They're having issues all the time. Employees do not show up. Employees late. The store is open late. The mall fine, gives them a fine or citation for not opening on time or closing early. Employee steals from the cashier. The truck broke down. There's always something going on. Now, he knows the business. That's his business. He's not concerned about it. But at the same time, he has a store. Will someone walk in the store today and buy something for me? And if not, that's very scary, So that's something that he does well and knows how to do it. But for me, that's a crazy idea. Here's how I like to do it. Again, my rental property is my little store, my little business. And look how wonderful and beautiful it is. I'm the owner, and I have a client. In the real estate world, we would call him a tenant. In this situation, we're going to call him a client. This client signs an agreement to be my client, pays me a deposit to make sure he will behave as my client, and on the top of everything, we know very well that the relationship is I'm in the power position and he's not in the power position. Typical business is the client is always in the power position and the service provider is not in the power position, right? That's typically how it works. In this situation, the client is not in the power position, you are, the owner. Now, I'm not saying there are not issues with tenants and we don't have evictions and we don't have all of that. It's there. I don't want to create a scenario where everything is dandy sweet and there's no issues. Yes, there are. I think it's in the bigger picture, it's irrelevant and we're maybe going to get around to it in the Q&A session. But if you understand that concept, a client pays me, I'm in the power position, he doesn't want to, upset me that I will evict him or he will lose his house or something like this. So that gives me a lot of power. Now, this little business has an employee. Who's my employee? Anyone?
You.
No. A property manager. We just don't call him in this world an employee. How do we call him? A subcontractor. What is the type of a relationship that I have with this subcontractor? The typical, customer service provider. I'm the customer now. I'm in the power position, and he's the service provider, right? Typically, that's how he or she wants to please me. He's not my employee. He's my subcontractor. Actually, he's just a vendor. So I don't have any, employer-employee relationship with this person. I can replace him if he misbehaves or whatever, he has liability and all of that. So that's a wonderful place to be in. I'm in a power position with my client, aka the tenant. I'm in a power position with my employee, aka the property manager. I love it. Now, let's think about this business that we call a rental for a second. What happens with it most of the time? Nothing. Thank you. Nothing. What does it mean? It's rented and it's out there and it, grows in value or, even if it doesn't appreciate, the tenant is paying the rent and it's lowering it's paying off the mortgage and it's building up equity, even if it doesn't appreciate. And it's generating a little or a little big, a better cash flow. It doesn't really matter right now. But it's growing in the background. Does this business, little business, care if I'm on vacation, if I'm traveling, if I'm out of a job, if I'm busy, if I'm bored? Assuming I have a property manager in this scenario, this little business doesn't really care what I do for a living. It's just there in the background. Now, this business, rental property, from my experience, on average, would probably need about half an hour to 45 minutes on average a month of my time. What? Are you guys with me? Half an hour to 45 minutes to take care of my business a month? I'm saying on average some month there's going to be zero. Tax season, a little bit more time. Maybe in vacancies I need to be a little bit more involved, watch over what the property managers are doing. More, on average, half an hour to 45 minutes or so. If I'm doing it correctly in the right way. I'm not going to talk about, if you buy in a terrible area with a lot of turnover or tenants, no, it's not going to be that case. If you manage it yourself, it's going to be required more of the time. But if you use a property manager, like most busy individuals you are using, that's how much time you're going to put into it. Yes?
Quick question. When you, what is the law about when you have to have a property manager? How far do Do you have to be?
As much as I know, there is no law that you have to have a property manager. It's more of a what you want to do. Mike?
I think what might be referring to state of California, if you have 16
Oh.
units or more, you're required to have an on-site manager.
So,
That's,
I think
but
that she meant from the distance.
From the distance?
Yeah. So,
Yeah.
distance-wise, that's true, but distance-wise, I don't think I manage some of my properties myself, out of state. For a variety of reasons. I got to that point that I feel comfortable doing it. Okay? Now, so this little business requires about so much of my time. Now, what I like about it next is, can I escalate? And the answer is yes. How do I do that? I go around, around the corner, across the town, across the street, whatever you want to call it, different subdivision, and buy another little business and duplicate. What happens? Nothing much. Well, sorry. It's going to take you now an hour on average a month and not half an hour or so. Okay, on average. And there are some people I see, people that own properties, and I see their hands, kind of moving in approval. They know what I'm talking about. So this is how I can duplicate it. Can I move on and buy another one? Absolutely. The number 3, how about number 4, number 5? I've been there. It's doable. More than that, actually. Much more than that. So, is it doable? Yes. Is there a limit? Well, probably when you get to 40 to 50, depends how small you are, you may want to consider hiring a part-time accountant to help you track with all of those things. You may be good with good bookkeeping or not. That's when you want to consider maybe hiring help to just help you manage those properties. But for the most part, if you do it properly, okay, and you're not going into an adventure type of properties, a very boring model of properties, you can duplicate, okay, and establish those side businesses again and again and again. And if we have time, and we're going to go over it, how to optimize the way that is not going to overtake your life with when you buy multiple properties. Over the years, I've learned how to do that. Yes?
So Danny, when you were getting your third or fourth property, did you have a job? Were you W-2 or?
So did you say when I was at my third and fourth? I did.
So you were able to get a loan?
I did.
For
I was.
Many different properties?
I got many loans over the years. It was easier back then, but I'm going to say the following. First of all, you may have more, you can probably get more loans than you think, okay? Some people, from my experience, they come up and they immediately think, I'm not going to be able to get a loan. How many more properties you have? 0. What? Do you have a bad credit? No. Do you have an income? Yes. And I'm going to talk about that in a second. So they're probably easier than you think. Is it going to be truly, when you get to 4 mortgages, it's going to be a little bit trickier. But if you can get to 10 mortgages, much more, problematic or challenging. Can you go beyond? Absolutely, there are ways. Private financing, not necessarily expensive private financing, partnering with a friend, maybe working in a way that if you're married, you and your wife in a different way. We can talk about it, offline, but my mindset is the following. No loan restrictions are going to hold me back from buying more properties. I will find a way. Not going to be easy, and may have to give up some profit to someone else, but there's always a way, okay? Probably many more ways than, like for example, some people have a lot of equity in their house and they can tap into a little bit of it and use their house. I'm not saying it's the right thing for you to do. Again, this is one of those things. I don't know if it's the right or wrong thing for you to do. But it's a possibility to tap into this equity. You have $1 million for your home, maybe you can put 100 or 2, maybe, makes sense, and use that. Okay, not even go to conventional financing. Okay, just to give you.
But isn't that why we all ran into problems with the bubble when it burst?
Not in my mind, because if you do it unresponsibly, that's why I'm going with a lot of precautions in my sentences. If you do it irresponsibly and you take 900,000 and you can't pay 900,000, absolutely it's bad. Don't do it, please. But if you're doing it in a way to say, you know what, 200,000 out of my equity of my home, I can handle it. If you're not sure, let's talk. We'll see if we can handle it. But I can handle it easily. I have a margin. Even if I lose my job and so on, I can still handle it. Okay? So that's one of the things I cover when I meet with people. So that didn't lead to that point. The overstretching, yes. Don't overstretch. Go buy less amount of houses and safer, okay? Now, going back to the side business. So what I said is we can duplicate it and buy another one, and another one, and another one. And I love the concept because those houses, if I do it properly, mostly what I'm looking for is primarily that they will cash flow, not even break even. If they cash flow, each one of those houses, from experience, I can tell you, is independent of you. What do I mean by that? It doesn't care if you lose your job right now, or if you're on vacation, or you just decided to take 1 year off. It doesn't really care because the house is self-sustaining. And it's not dependent on your income, it's not dependent on any other house's income, and it's probably the best way to buy houses. That's what I mean. Don't buy 20 properties that are stretching you and they're negative cash flow or breaking even. Buy 10 that are positive. That is a much safer way. I would love it if you come and buy 20 houses with me. I would hate it if you start losing that situation. I would be there to stop you probably. Okay, so that's what I mean by the side business idea and how real estate is one of those things. Why would I want to start a store and deal with employees? I have my job, I have my life, I'm busy, kids. I'm just going to have this rental and another one and another one and another one and so on. Slowly, I may just do it one at a time, 1 a year or so, and I'm going to see how that works. But that's something that is really easily can work in the background, okay? And by the way, in my example, it may require about $20,000 per property, and again, you're going to see that. But it doesn't mean it has to be $20,000. Those properties in Atlanta are cheaper. You could probably do less than 20 per property. All right, moving along. Occupational fuel, very important, okay, very important. Every once in a while, not as much as before, someone comes up and says, I want to quit my job, my corporate job, and start doing real estate full-time. Great, I love it. I wish you would be able to do that. But mainly two things will happen when you do that. One, when you have a job that produces a stability of income, who loves you? Your wife, first of all. But who loves you better? The bank, the lender. The lender looks and says, I like him. Stable, stable, stable. That's what I'm looking for, right? So what does it mean? If we understand, if my solution is to buy, remember the first sentence of multiple properties, if my solution to build that financial foundation is multiple properties, what do we need? Multiple mortgages. What does it mean? We need the lender to love us. Good credit as much as we can and have a steady job. They love it. So that's point number one. Point number two. If we want to getting to the point that we buy 16 properties. Let's say we are buying one property a year. Why? Because one property a year, it's our profit between what we make every year to what we spend. What we spend is the cost of our living, vacation, house, whatever. Let's call it $25,000 we are able to save every year. So that means this job allows me to buy one house per year from my saving. Okay? If I do real estate full time and I'm able to generate the stability that the lender would love me and the cash to buy more properties, because when you do real estate full time, that doesn't mean, that's your job now. Yesterday you were an engineer, today you're a fixer-upper or whatever. What do you do with with what you save every year, and how do you invest it? Okay? So your job, it's important both to fuel you with cash to buy more properties and the stability, the lender provides. Okay? Now, to end this part, I want to say the following. I already said when I got started, I paid $140,000 for a house in Phoenix, and the rent was either 6 or 6.5. I don't even remember. 6 or 6.5%, which is not too bad, by the way. It's okay. Is it good or bad versus what we are, in the scenario we are in today? Terrible. I thought it was terrible. Now it's good. Right? That's what I meant. Now it's good. Now the same house is $85,000. Actually, the true value of the dollar, because it's been almost 10 years, okay, it's more like $70,000, right? And the rate for investors, 4.5% to 5%, around that. maybe a little bit more, even 5.5. Okay, that's an amazing, time we live in. So on the top of everything that I said, if you start today, your starting point is going to be much, much better. I envy you. It's going to be much better than my starting point. Okay? So that is a pretty amazing thing if you tie everything together. All those features, it's get better and better and better. And on the top of that, the timing is just amazing. Price-wise, we can't dispute that properties are cheap. And interest-wise, we can't dispute interest is very low. Okay, moving along. Everybody's with me. Basic is clear. Okay. So let's talk about 3 scenarios now. Now that we understand the foundation of real estate, of real estate and real estate investing, what I just talked about. Now let's explore 3 different scenarios. And remember, I want to accomplish that goal of multiple properties. Okay? So let's talk about the basic scenario. House number 1, just an example. Single family home in Phoenix, purchase price $85,000, all real. 3 bedrooms, 2 baths, 1,500 square feet, 2-car garage, built in 2003, good school districts. Nothing too fancy. Just a simple subdivision, suburb, typical house. Let's look at the numbers. Purchase price $85,000, loan $68,000, down payment plus closing costs, $20,000, interest rate 5%, annual rent income $12,000, annual mortgage payment $4,250, annual expenses $3,800, net cash flow, let's round it up, $4,000 a year, or $330 a month, right? This is a typical example that I see in Phoenix. Nothing beautifies, nothing fancy, this is just realistic. By the way, when this house is free and clear, it will generate $8,160 a year, which are $680 a month. Yes?
What do you have in that annual expenses that seems so high?
Annual expenses, when I calculate, it includes, besides the mortgage, taxes, insurance, some repairs, some vacancy, maybe HOA, depends, property management, leasing fee. So I don't put it, it's not listed, but I just want to summarize it. So that's why I say it's realistic. That's why it maybe seems a little bit hard. Okay? I put everything in. I don't skip, I don't try to miss on anything. Okay? All the real numbers. Okay. So what do we do? Situation like this, remember, we're still at the basic scenario. What do we do here? We hold the house. We get $330 every month in cash flow. We pay, or $4,000 a year. We pay the mortgage in 30 years, or we sell it, right? Anybody think that's something new? Okay, no, absolutely. Now let's see how we can accelerate this situation. Okay, remember, one house. Let's see how we can accelerate. We're going to go to the extreme for a second. We're going to take 0 cash flow and apply all the cash flow that I'm getting every month as an extra principal payment. That means every month I'm going to pay $330 as an extra principal payment beyond the normal mortgage payments that I have, an extra. Okay? That is a type of an acceleration technique. Nothing too fancy. Simple. What have we done? We took an extra $330 and we pay every month. That's it. Is it doable? Absolutely. Is there a problem with the lender? For the most part, there isn't. You may want to find out just to make sure or call. Normally, there are no prepayment penalties, even today, right, Mike? From the get-go. So it's not a problem, okay? So every month, what am I doing in this situation? This house is going to be paid off in 12 years. Remember, $10,000, 12 years, I'm getting to that point. So that means in 12 years, I'm going to have one house completely paid off, generating $680 in today's value, not in 12 years value, to my pocket, okay? And I saved, what, $41,000 on mortgage, on interest and saved 18 years. I should have said saved 18 years and I saved $41,000 in interest. Now, let me give you a little story here. when I kind of thought about this concept about a year ago, I went to my friends, my best friends. They live not too far from here, in Mountain View. They are not investors. They are just, a couple, double income, no kids. They live not too far. They own their own home. They just refinanced their house to get a better rate. And I told them, maybe you should consider doing something like this. And I explained to them, they're both very intelligent people, but not sophisticated when it comes to numbers and, and investing and so on. And we sat over the weekend and I explained to them the concept, and they thought about it, asked some questions, and said we would follow through. And I thought, they'll probably let it go. They are the type of people that won't actually look into it. She calls me on Monday and she says, I spoke to the lender and there's no problem for me. I just want to make sure there's no problem for me to pay extra principal every month. And we're thinking how much and we're kind of digesting. Thank you. Okay. She calls me on Wednesday with tears in her eyes and she says, I don't know how to thank you. I said, what's going on? She says, 2 things happened to us. First of all, we're going to save $163-something thousand in interest. This is amazing for us, okay? We're double income, no kids, but you know us. You know this is a lot of money for us. But mostly, we decided to do it in a way that we're going to pay off this house instead of 30 years, in 20 years. That's their house, not an investment property, in 20 years. That means we're going to finish paying this house when we are 55 and not 65. So I said, good, why are you crying? She says, because when I'm going to be 65, we're going to be 65. We want to be retired. We don't want to work. And you, but just telling us, created a situation where we're going to be free and clear of this financial burden when we get to our retirement. This is an amazing, impact on our lives. So that is, when someone asks about here, this is something every one of you can apply. And we're going to see how you can apply it. Regardless if you have rental property or your own home. If it makes sense, remember, if it makes sense. Now, what do I like about this plan? Why do I love it so much? It's extremely flexible. What do I mean by that? Let's say 1 month or 2, let's say that there's a month, the house is vacant. Do you have to pay the extra principal payment? No. I'm not going to pay the extra principal payment. Next month, it gets rented, and guess what happens? There's a leasing fee, and you don't get the same cash flow, and you want to pay yourself back for the vacancy. What are you going to do? Not pay the extra principal payment, right? So there's a lot of flexibility. Tough month, you pay a little. Some, zero. Good month, you pay the most. Whatever you want to decide. Do you need a sophisticated calculator to calculate that? No. Do you really need to look into a contract? Can I pay or not pay this month? No. This doesn't get more flexible than this. You decide how much and when. Okay? Maybe you can say, you know what, actually I will put an extra $50 every month to get it not in 12 but in 10. Or maybe say, you know what, my favorite thing actually is as follows. It's actually very round numbers. My favorite, when I always tell the investors to do on a typical kind of schedule, let's call amortization, accelerated amortization, is as follows. Go by the 1/3 rule. 1/3, $110 in this example, pay as extra principal payment, $110. The next $110, set aside, like a reserve fund for the house if when something happens in the future. Okay? 1/3, the third $110, treat yourself for something nice. It's very important as investors, believe me, that's what I think, not only to enjoy the fruits of our labor in years to come, but also today. 10 years, almost 10 years, I'm receiving rent checks. I have to admit, every time the rent check comes in, and some people heard me say that before, I get a smile on my face. It's like I don't believe it's working. I know it's working, but you know what? Again, the rent check came in, checks came in, and again and again. I love it. What can I say? And there are times that I really needed those rent checks to help with income that went down. How amazing is that? Okay, so that is something that's truly Amazing. You have all the flexibility, and it's okay to treat yourself not only to pay for the future, but also to pay to the near future. Yes.
How do you determine if tax deduction and interest brings a more advantage to you that versus paying off the full house?
How do I determine? Again.
Advantage in tax deduction and interest versus paying off.
Way too complicated to answer, I think. Okay, it depends on your own taxes, and there are multiple factors that need to play here. I don't have the answer like that. It's probably something I need to.
Well, if you have only 1, 2, or 3, it's going to be more advantage to have tax deduction.
Okay, so let's talk about for a second. Let's talk about for a second. Is it good or bad to accelerate and pay the extra principal payment? I'm making it sound like it's a perfect thing for you to do. Is it the right thing for you to do? Well, let's talk about that for a second. So first of all, really at the last slide, I think, of this presentation, I'm going to bring it together, like I said, and show you how to incorporate it to a truly good plan. But here are the disadvantages, I should say. When you pay the extra principal payment, it means that you're actually, I'm contradicting myself. Remember what I talked about, the mortgage miracle? If this mortgage miracle is so beautiful, why do I want to pay it off sooner? I should stretch it more than 30 years if I can, to 60 years if I can, right? It's an amazing gift. Why would I? True, I agree. How about some may say there may be some tax consequences that I'm missing on? I agree. How about some may say, but you're putting money in the wall. Okay, maybe someone will sue you and there you have more equity. I agree. There are some disadvantages, no doubt about it. But let's think about it for a second. What is the goal here? What is the first slide I showed with the goal? Right? 10,000, 12 years. If this is my goal, then of course I'm going to make some trade-off on the way. Is this what I'm trying to accomplish? Then probably this is a good path to follow. If this is not what I'm trying to accomplish, I should probably modify the plan to make sure it satisfies whatever I would like to, I'm trying to accomplish. So it's not true for everybody in the room, but for some it may. So that's what I'm saying. We have to understand your situation and to see if that works. But for me, what's the most important point to make, the point I want to make is as follows. So, this is so trivial on one hand, but so many people are not aware of it. There's nothing sophisticated. There's no, I wish I could patent it, okay? Truly, I would make a lot of money just from patenting this idea. It's simple, doable, and not really common knowledge out there. It may be the right one for you or may not. On your primary residence or your rental properties, it may or may not. But it's available. Guess what? For free. Okay? Enjoy it. So that's what I mean, and that's what I mean, is it the right thing for you? And tax consequences are part of it. I completely agree. Okay, moving along. Remember the first house, right? Let's just remind ourselves, bought it, so on. We paid it off quicker, sooner. What are we going to do next? Okay, first year, bought one house. Let's say apply the mortgage acceleration technique Danny told us about. Okay, let's say it makes sense. What do you do in the second year? Thank you. Buy another one. Remind me to give you one house when you get it. Just kidding.
Sure.
Thank you. Exactly. Buy another house. House number 2. The same house. Not the same house. House next door, down the street. Bought it a year later. Okay? Why? Because that's what I can do. I can only buy one house per year because of my income, whatever. Okay, let's say I buy 1 year. The first house, if you do the extreme, say the full $330 mortgage, extra principal payment, right? And I said it's gonna take about 12 years to completely pay it off. What's gonna happen with the second house? You already have the answer. 11 years. Why? Why 11 years and not 12? Thank you. Exactly. When the first house is completely paid off and generating almost $700 a month, what am I doing with the $700? Paying the second house. right? Okay? Again, remember, what is my goal here? The 12 houses, or, sorry, the $10,000 in 12 years. That's what I'm trying to accomplish. So, what am I going to do next? Avi? Third. How long is it going to take to pay it off?
10 years.
10 years, most likely, okay, roughly, okay, keep that in mind. It's not going to be, why? Again, now 2 houses are going to pay off for this one. Assuming, by the way, when I say 12 and 11 and 10 years, it's assuming I don't skip a payment. I go all the way on the scale of paying full extra principal payment every month, okay? 10 years. By the way, 10 years from when I bought it, it's 12 years from now, right? Because we bought it a year later. Do I need to ask you what am I going to do next?
So are you making the extra principal payment for only the first house, or are you making them for all 3 houses?
Year number 1, 1 house, extra principal payment, the max that I can. Year number 2, 2 houses, both. Extra principal payment on both of them, the maximum that I can. Year 3, 3 houses, extra again. Now, 12 years gone by, okay? I have the first house completely paid off. The minute that house is paid off, I'm helping with this one to pay for the second one. So I'm making not just the extra principal payment that I make I made every year on the second house. Now I'm adding another $700 in today's value. You with me? Okay. And so on. And then I just continue to do that. All right? Okay. I think we got the point with the multiple houses and multiple extra principal payment and getting those houses quickly and sooner paid off, and it gets a little bit better in a minute. Let's just review what we have here before we move to the third scenario, which is, I call it the turbocharged scenario. So what do we have? 16 houses. Actually, by the way, to achieve that goal, I actually need only 15 houses, but I added another one just to make it even better. So one free and clear house generates $680 in this example. 15 houses are generating, it says 15 actually, $10,000 a month. 15 houses are generating $120,000 a year. Okay? Can you really internalize that? Let's say you work, and this is today's value. And let's say you work, there are young people in the room, you get paid for being an employee, and let's say you make $120,000 today. Now, let's move on 12 years from now. Let's say this $120,000 in 12 years value, let's call it 150, okay? Hopefully more, whatever, 150, because inflation and cost of living, etc. And let's call this $120,000 here at the bottom, in today's value, over here also 150,000. So that means in 12 years, you're going to have $300,000 coming from your income and from the houses. Okay, before taxes, of course, both. Wouldn't that be a very sweet position to be in? Wouldn't that allow you a lot of flexibility in your life? Maybe you're going to get to the point that you're going to say, you know what? I need to make a career change. I want to go follow my passion and not my need now. Okay? Maybe your passion is in a personal trainer and you need to build up a business. Can you do that? Absolutely. You have $120,000 coming in and you have a year to kind of build your business or whatever because you have some money coming in. Now, if you want to travel, you want to retire, whatever. By the way, those houses in today's value, they're almost net worth of those houses because they're free and clear is almost 1.3 million. Obviously, it's going to be more in 12 years, but 1.3 million. Let's not forget that. If we have, we have a kid that we need to send to college, what do? We sell one of those houses and pay for college. Actually, if I were you, I would just refinance, use the money, keep the appreciating asset or the value, the wealth building asset, and use the money to send the kid to college. I wouldn't sell it, just 1 second. Okay? But you can do that. Yes?
What happens with the normal 13-10-year cycle where property goes up and down and it goes underwater? So I mean I made my first 6 figures or 5.
So
what do you do that?
Okay, so you came a little bit late. That's not a problem. If you don't mind, when we get to the Q&A, ask that again, because that's a little bit of a long questions, okay? We good?
Yeah, wait.
All right, thank you. All right, so far, we're good. Everybody, you're with me? Anyone lost me on the way? You know, the puzzle is still kind of being built. We're moving to the third scenario, which I call it the turbocharge. Why do we need to turbocharge, first of all? Who says I save up $20,000, $25,000 every year that I can buy a house? What if I don't? What if I only able to save up 10? So that means a house every 2 years or so? That's not good enough for my plan, right? So we need to kind of kick it in the butt somehow and expedite it, turbocharge it. How are we going to do that? All right. Remember for those of you who are here, I gave that example earlier. I'm going to repeat that. This is a fix and flip in Atlanta. It was purchased for $30,500. There's going to be a planned rehab of $15,000. It's going to, all in is $45,500. The plan was to hold it for 4 months. We're going to sell it for $75,000. There's a sales commission. There is some, a total profit. I'm splitting the profit with the team, my profit, etc. Let's say out of this deal, I made $10,000 or more, a little bit more, okay? For those of you who are here, you know already, I showed that example. Actually, it's turning out to be better than that plan. But I want to stick with what, reality and not what, good examples that may happen. So I made $10,000. What I'm suggesting, in order to turbocharge this concept, is to use fix and flips as a part of your wealth building or real estate portfolio building process. And let me explain that a little bit better. As I said, I've been doing it for many years. Up until 1 year ago or so, I had a battle of thoughts going on in my mind for years. My cup of tea, for years I've been doing only rental out-of-state properties. For years, that was my specialty. And then I always told myself, you should do fix and flip as well. But then I said, fix and flip, it's kind of, in TV it looks scary, and they kind of, I don't know how I'm going to do it, and out-of-state, etc. And I said, and then, rental is better. And then I go to the rental, I said, but, rental is good, but it's not generating enough cash now. You need more cash now, not just cash in the future. So you should do fix and flip. So I was going on. Fix and flip, rental. Fix and flip, rental. Something amazing happened about a year ago when I was walking and kind of thinking. My thought all of a sudden came and said, hold on. Who says it needs to be this one or this one? It should work together. I felt it was so trivial. Of course it should work together. They complement each other. So in my mind, the way you should be doing it, it's not this one or the other. It's both. Why? Because both of those engines, as you can see, short-term engine and long-term engine, have advantages and disadvantages. But in the bigger scheme of things, the fix and flips, my short-term engine, I do 1 year, making $10,000 or so, like I said over here, a little bit over. I do another one, let's say I'm only able to do 2 years. So I made this year from a fix and flip, $20,000 or something. What am I going to do with the $20,000? Buy another house, another rental. So that's what I mean. The short-term fix and flip, short-term engine feeds my long-term engine. They don't have to work against each other. They are working together. Okay, please someone might maybe remind me to talk about when I say fix and flip a little bit later, what do I mean? So we have more of a clarity about it. So they work together. So let's say I'm able to save on my own work $20,000 a year. And I'm able to buy one property a year. What happens with the fix and flip? 2 properties a year, right? So that's what I mean with those two work together. One fits the other. I'm not saying do the fix and flip in order to have more cash in your life right now. I'm saying do the fix and flip in order to have more cash to buy long term with the mortgage miracle and all those beautiful things I talked about. One fits the other. Now, let's take a quick summary. because we're kind of going a little bit, round and around. So my goal was $10,000 per month in 12 years. I need 15 houses in order to get to that, to achieve that goal. Basically, 30 years, right? Simple, but that's not going to take me in 12, I'm not going to get there in 12 years. I'm going to accelerate it, AKA extra principal payment. I'm going to get there in 12 years. Yes, I can get there in 12 years. But I can't get to in 15 houses because I don't have enough cash or I don't make enough cash for my job. What am I going to do? Integrate the fix and flip, what I call the short term, into my, my plan and get there quicker, sooner. Now, before I want to show how to actually put it in real life, is everybody with me? Too complicated or actually rather simple? Simple. Easy to follow? Okay. Maybe before I talk, next I'm going to show how to actually it should be implemented in life. And then I want to say a few words, what do I mean by fix and flip? And are those properties available or am I kind of making it up as I go along, which I'm not? Okay. So in reality, the plan that you should have is as follows. Phase number 1, accumulation, collecting, buying properties. In other words, do not in the first few years, let's call it 5, 6, 7, 8 years or so of the plan. Okay? You're not going to pay extra principal payment. You're going to focus on fix and flip and buying rental properties in order to accomplish that goal. Why am I not making the extra principal payment during this time?
You need the cash to buy property.
Thank you very much. Exactly. I want more cash to be able to help me buy more properties. You deserve 2 points, coming late and catching up very nicely. I like that. Thank you. So I'm going to do rental and fix and flips, right? And I'm going to use all the cash that I have because I want to get to the point that I have maximum number of properties that I need. What am I going to do phase number 2? Let's say year 7.5 or year 7. What am I going to do? I got to the point that I have the number of properties that I need. That's in this case 15, maybe in your case more or less. By the way, this example that I use 15 houses, someone may come up and say, you know what? I don't need 15 houses. You're crazy, 15 houses. What are you, nuts? Okay, how many do you need? 5? Same idea. Do that in the same principle. And someone else will tell me, crazy, 15 houses is not going to cut it. I need many, many more. Can you do more? Absolutely. 30, fine. The same idea. Okay? Or the same techniques. What am I going to do at year number 7? Start paying them off. Now, will I stop doing the fix and flip? Why should I? What am I going to do with the profits from the fix and flip? Pay it off. Use the proceeds to pay off. Instead of buying more properties now, I'm switching from buying, second phase, starting to pay them off. Using the tweaks, the fix and flips to pay them off. Okay? So I'm not losing that short-term vehicle, I'm just applying the proceeds in a different way. And that's going to take me to that point. Now, from my experience, most people, when I talk about 15 properties, they think I'm nuts. Okay? What are you talking about? It's crazy, 15 properties. You know what? You're probably right. First of all, thank you. If you call me nuts, I would see that as a compliment. Most of my life, people did, when I got started and started investing in U.S. properties while living in Israel, all my friends thought, I was in my mid or kind of mid-20s or a little bit after my mid-20s. My friends called me crazy. You don't know what you're doing. Nobody did it around me. And when people stop calling me crazy, I get offended that I'm not that. But it's not crazy. Nothing crazy about it. So how do you get started? Some people in this room already gotten started. The only thing they need to do is actually see how to apply those techniques into their existing portfolio. Some people are on the verge and are sitting on the sideline. Actually, many people are sitting on the sideline and they're afraid for whatever reason. And the way I can help you with overcoming this fear, there are 2 options. Quick, short, and cheap. Sign up to meet with me. We do a strategy session. There are people in this room who've done it and may want to testify to the quality of it if they want. But you do a strategy session, we kind of work it out, and I help you to move forward. Some may say, you know, I'm still not knowledgeable enough. What do I do? Simple. Sign up to the class, learn how to be a real estate investor, and then go ahead and apply it. So you're not going to start next month, you're going to start a month later, but with more knowledge, confidence, and less actually fear, and possibly a lot of mistakes that I have done. I will share them so you will avoid them. Okay? So whatever you need to do, you need to start with 1. Forget about 15 for a second. Many times I tell my investors, forget about this. Start with 1 or 2, and then let's talk. Actually, many of the investors I work with come to me a little bit, you know, they went, move forward, they did 1 or 2, and now they're stopping, saying, asking themselves, what am I doing here? And that's when sometimes they need help to kind of say, okay, am I on the right path, wrong path, am I doing correct or wrong? And they come up, and then we optimize whatever they have existed. And it's okay. At least they broke the barrier of number 1, which is the difficult one. And if you want to do, you know, if you want to sign up to either the class or the meeting with me, the sign-up sheets are here. I'm missing one, by the way. There's a one clipboard. Okay, are you hanging on to it?
Yeah.
Thank you. Thank you. Okay, so I'm gonna take questions now. This is my contact details. You next to the table, or at the entrance, if you don't mind turning on the lights right there. You, yeah, right there. Thank you, so you can see me. And let's take some questions. Okay, so you had one. Can you repeat that, please, for me?
Yeah, how are you going to deal with the fact that like 30% of the property in the United States is down, underwater, permanently, structurally because of financing and the interest rates? How does that apply to your model? How do you see that being a way by which you can guarantee the excess net operating income you have?
So, what you're saying, I'm going to repeat it. How do I see what I'm talking about here in conjunction to the fact that a lot of properties are underwater? Couple of things. An underwater property, for me, means I can probably buy it either in a short sale or it's already been foreclosed in most parts. Am I losing something here as the buyer and the investor? Am I buying it right now? You know, if I'm buying in that situation as an REO for short sale, assuming the number's okay and work, I'm an investor. I'm not going to buy it for numbers that are not, you know, working in my favor. How's my starting point? It's good, I would say. Now, on the top of that, does it mean I should go to every market and invest in every market? The answer is no. Okay, for example, here, will this be applied here? Can you apply this here? Probably not. Just, you know, the greater Bay Area, maybe some pockets you can. Why you cannot really apply it here? Well, large down payments, of course, expensive houses, very, very low rents relatively to the price. It's not very applicable here. What I follow, I go to markets that are showing that those numbers exist, which are, I focus today, for me and my investors, on Atlanta, Phoenix, and Dallas. Those numbers exist in those markets, okay? They can sustain the plan that I'm talking about. And by the way, those markets are showing growth during this time. Dallas is showing significant growth. Atlanta is doing okay. Growth, I mean jobs and population, okay? And Phoenix and Dallas, you know, Phoenix and Atlanta are okay. So there is unemployment out there, but they're still showing growth. They're very stable, strong metros. That's what I like when I follow. I didn't even talk about what metros I like. That's the type of profile I like to go to. I don't like to go to areas where there's a out-migration. By the way, there's just on my site, on my blog, on simplydoit.net, just a week ago, I posted a research, Atlas Van Lines. Everybody knows Atlas Van Lines, they're huge. By the way, it's the third time, you know, I put it on my website. Every year they release the previous year, you know, migration patterns. And they're showing you exactly which state is balanced, meaning in and out the same, where people are moving out of, where people are moving into. South and Southwest are growing. Northeast, for the most part, is shrinking. Do I like to follow the pattern of growth? You betcha. Of course. Some ask me, I don't know the Detroit market, but what I know about the Detroit market, because people ask me once in a while, is I'm afraid. Cheap as it may be, I'm a little bit afraid. Maybe I'm, you know, not knowledgeable, or maybe it's a stupid decision to say that. But there is not a lot of industry going on over there. There's not enough growth jobs going on over there, and that concerns me. Mostly for the fix and flip. I need to be able to know there's going to be a market of renters, a growing market of renters that will rent from me, right? And will pay me those rents. I want to make sure it's there. So that's the essence of it. By the way, smaller markets, there's some boom in North Dakota, or maybe you saw it on the news, or, you know, north of North Dakota, or whatever you want to call it, you know, South North Dakota, I don't care. There's some city they found gas, and there's a boom with oil and gas over there, and someone just asked me about it. And you know what? It's fine. It may be a good short run. In my mind, it doesn't really sustain my model, because my model is a long-term, for the rental, a long-term. What happens if this big employer, his ship drowns across the shore of the the Mexico Bay or whatever, like we had just now, and this company suffers a bad reputation and fines, and all of a sudden this area has to let those people go. Do they have another employer over there to take them? I don't know. If they do, that makes sense. If they don't, it's too tricky. Too many employers in one area, one of them goes, belly up. What's going to happen for the area? What's going to happen for the real estate? We all know that. I like Dallas. Multiple employers, big corporations and small. Atlanta, same thing. Phoenix is nuts. Close to 6 million people that are calling Phoenix their house, their home. Why? I don't know. It's hot. But I don't care. I don't care. It makes sense, right? Numbers make sense. So by the way, it's not just location, location, location for me. It's more like numbers, numbers, numbers. Numbers, numbers, numbers are market-wise and property-wise, and not just one or the other. Yes?
Sorry, I hope I didn't interrupt somebody else who wanted to ask a question.
Go ahead.
The combination of, so you see that you look at a lagging indicator like movement, economic growth in those areas, adding jobs to the region. What are some of the other metrics you look at? Do you look at a arbitrage between the cost of property, how much they make?
Probably the next thing I would try to make sure is there that can sustain is the purchase price, not going one step, one level deeper. Now we're talking about the property. What I'm looking for is to make sure, unlike here, over there, what is the purchase price rent ratio? It has to make sense, okay? I have to admit, Atlanta, the purchase price rent ratio is amazing. It's probably the best one, and one of the better ones in the country. I don't know for a fact, but I think so. But Atlanta, the way I see it, there's a smaller potential of appreciation. I don't know, that's my guesstimate. In Phoenix, the ratio is probably not as good as Atlanta purchase price rent ratio, but my guesstimate says, based on my experience and some indicators, that there's a better potential for upside. So it's a balance between those two, right? So we just have to make sure what works when it comes to those parameters. Yes? Yes?
Your sample on the resale will most likely double from when you buy. Is that really realistic?
So you have to, if you can raise your voice a little bit and repeat, please.
Almost all of your sample, when you buy, let's say 35,000, you double more than 100% resale. Is that realistic expectation?
So, no. Everything I showed as an example is just real life. That's what happened. When you look at it's not far from it, but when you look at this one, okay? So, were you here when I showed the 3 examples at the beginning? Okay. That was this house. But I showed what's actually happening, which is better than the plan. This is realistic. This is what should be happening. Okay? This is okay. This is what should be happening. The fact that we're able to hit a better situation and get more out of it, it's more luck than anything else. But this is still good enough. What do you mean it's still good? This is very good.
Yeah,
This is good. This is something we can duplicate. Okay? So I have analyzed my team in Atlanta that does the fix and flips. I have 3 different teams that does 3 different programs in Atlanta. My team that does the fix and flips, they gave me 11 deals, recent deals, in the past several months. I've analyzed it. This is very typical of what those deals are. Okay? Very typical. Give or take, but that's typical.
So you buy 30,000, you sell it.
You buy 30,000, but you're actually putting in 45,500, remember? Because there is a rehab cost. And then you sell it for 75, but there is some sales commission. And that's the profit you should be expecting. This is typical. This is very representing of what's available out there. There's no tricks. There's no special, by the way, if you can see here, I know it's a little bit harder with the...
What I mean is it really realistic for you to buy 30,000 and then you sell it? I mean, more than double.
Yes.
It happens, yeah.
This house was purchased, no secrets, I'll tell you exactly. We bought it at the auction. Yes?
When you say, like, your team, you have 3 teams in Atlanta, is this like real estate people who look out for you? Are these contractors who come in and fix up these homes? Who are the people that are in your team? How
Okay.
do you find these
So
people?
who are my teams? When I say your teams, what do you mean by your teams? So I said I've been doing it for many years. I go to a market, I think it's a good market for myself and my investors that will come and follow, let's say, my lead. Okay? Will listen to my advice, and there's a reason why they should not listen to why my advice makes sense. And it's based on the years of experience. By the way, the reason I think I'm very experienced, it's not just because I bought many properties over the years. That's a small portion of the amount of transaction I was involved in with my investors. That's truly my experience. Now, most markets, typically, I would have a realtor and a property management company. That is the basic foundation in every market. And I normally have one realtor or team, and one property management company. I like to concentrate my efforts with them, so they would have all the incentive to service us better. When you invest with me, they love me even more, which makes sense for me with them. Okay, that's typically in Atlanta. Now, when I went out and set those teams, I'm always looking for people that you can easily go out there and find someone that can do rentals. Most people, realtors, would either tell you or would be okay with it to do rentals, meaning investor out of state buys rental, property management company. You know what? It's not that difficult. There's some art to it and some science, but it's not complicated. When I'm looking for a team, I'm looking for someone that can do that, but must have the experience of doing fix and flips. Why? Because I want to implement the plan. I don't want to just talk about it. By the way, I'm not just talking about it, I'm implementing it myself. This is my house. This is not just an example out there. I'm doing it. So this is something I'm looking for. So those teams have to have another layer, which not a lot of agents or teams out there, they have another layer of being able to do that. In Atlanta, I was able to come with 3 different teams. This one, the typical one I just told you, an agent that will help out-of-state buyers to buy REOs from the MLS and whatever. I'm not going into the fine details how it works. And then the property management companies. By the way, she's probably the best property manager I've ever worked with in my life. I've seen her behave beyond what I normally expect, way beyond what I would expect from a property manager. Then I found another team that actually provides a turnkey. They go, they buy, they rehab, they rent it, and they say, Mr. Investor, please purchase this house. Not for this price, $75,000. For $50,000, $55,000. Why? Because they do a lot of transactions. And they only work with individuals like me. If you go there, they will tell you, we don't work with you. Okay? We only work with few individuals. And you can buy those properties. And it's all, you don't have to go through, that's good for the rental. The third team, and that's actually, goes to what she asked about, the third team, which is this house, or this example, they specialize in buying at the auction. Now let's talk about fix and flip for a second, because I think there's a lot of misconceptions. What does it mean? So let's put it in my world, what does it mean? Okay? In general terms, most fix and flips are as follows. Let's take this example in more details. This house was purchased at the auction. Before they went and bid by the courthouse steps, if you heard about it. Before they went and bid on this house, they did an extensive title search. Not title insurance, not title company, one of their people. Why? Nobody wants to get a house with multiple title issues, because it's a mess. Is it a guarantee? No. Have they had any problem in the past? Not something that they didn't know about. Meaning, you may buy something with a lien issue that you know there's a lien issue and you're going to pay it off because it's only $300. So they bought this house. What they do, thank you. What they do, yes, thank you, is normally, typically, what they will do is as follows. They will, the houses, almost of them, I went there, I saw the work in multiple houses when I was there. Typically, paint all over the house, power wash outside, all of the house, new appliances, new carpets, touch-ups, maybe all of that. And then the reason I like those guys is they go the extra mile, which nobody else, even not the turnkey people, go over there. What they do is as follows. They say, we know that in order to sell it, we have to go to please our buyer. Our buyer are not investors in this situation, but our homeowners. So we're going to do the following. First of all, when we fix it up, we put nicer fixtures than the standard. Nothing too amazing, but nicer. Then we go to the garage. We finish the floor, and we paint, at least with the first layer. We finish the garage, so it's nicer. Why do we do the garage? When the wife comes in, she looks at the kitchen, she loves it. That's a wow factor. When the husband comes in, sees the garage, that's the wow factor they want for him, because they want to seal the deal. They saw that it's working. Nobody does that, not even the turnkey. I didn't see any house except theirs. And they don't just finish the garage, they do it really nicely with sparkling whites and whatever. Next, they're staging it. Not entirely, but they do, some staging in the living room and in the dining room and this master bedroom. Why? It gives it a little bit, that. Nobody does staging, okay? So they understand that. And then they price it aggressively. So that means they're saying their line of thought is as follows. If we do that well, what's going to happen? We're going to sell it quicker. What are we going to do? We're going to recycle, that's how they call it, the funds and buy another one. That's their line of thought. If we make a little bit less of a profit, we're able to do it correctly, we're going to do it again and again and again. That's what they want to accomplish. Okay? They would love to accomplish 6 a year and not just 2 or 3 or 4. Okay? So that is a typical situation. Now, do they replace the cabinets in the kitchen? Very rarely. I mean, very rarely. Do they maybe put new tiles if needed in the bathrooms or something like that? They don't go extensively into serious. They want to move in, do a good job, quickly move out. They don't want to get stuck. They don't want issues. That's a very typical fix and flip. By the way, in Dallas, the same thing. In Dallas, you almost always have the foundation issue, which is, it sounds issue, but not always a big one, but it's always there. But besides the foundation, similar thing, okay? Very typical, okay? Yes?
How come your total profit 25K now? It's 11, not 25.
Yes, so the question is, how come the profit is, the total profit is 25,000 over here, and then my actual profit, my profit, is 11,250. The way I work with this team, the way they work, is they say, we don't charge you for the work we are doing. The 15,000 goes directly to the labor and material, subcontractors and material. We don't get paid. When you sell, we split. Your take is 45. Actually, your take is 45. They are taking, no, 40. Aren't you going to ask for the missing 15? Where's the missing 15?
That's the full closing cost.
No. What about me? That's my take, I get 15. Me, Danny. Yes. So for facilitating all of that, I don't charge you a fee. That's what I get compensated. Okay, so 45 to the investor, 40 to the team, and 15 to Danny. Okay? That's the way it works. Yes. I have to get paid.
Commission is the realtor.
That's commission.
What's a realtor?
A realtor. Both realtors. Yeah? Typical commission. Okay? Any other questions? Yes?
Do you see each one of these houses, or do you just buy them and invest in them site at the same?
Okay, so two different two scenarios. Auction and non-auction. auction, normally, they will do a lot of research in terms of the area, the street, the house, the title. They will go to the property. Now, in an auction situation, they may be able to go in, maybe. If not, they may be able to walk around, okay, and try to see what the condition is. And sometimes not even those two. So that means they're not always going to be able to see what the condition of the property is. It's a little bit unknown. It's all factored into the equation of, the less they know about the house, the less they're going to offer about it, on it, or not, not offer at all. If it's an MLS or a turnkey, you're going to see the property. You or the agent that is buying it, they will be able to go to the property and go and look at it and tell you. I can tell you, when I was in Atlanta and I drove with the agent and we went to, I think, 10 houses in one day, one of the houses, he didn't know, right? He doesn't go to every property at that point. He will go there when the investor says, I'm interested in this house, he will go and look at it. And we said, this house was bad termite situation. So we skipped it. I said, I don't want this house. So obviously, he knew that, but I just expressed that, so he would know what I'm looking for. Then another house with a big crack in the garage. So I said, that's not typical for Atlanta. I don't want to deal with it. Let's not, forget about it. So he will go and look for those. By the way, you still have an inspection, not in an auction. When you buy not in an auction, you still have inspection, and you pay for it, and there's no problem. Okay? I mean, the inspector will tell you if there's a problem or not. Okay? Any other questions? Yes?
Do you have clients that are using self-directed IRA money for this type of investment?
Not at the moment. I don't see problem why you wouldn't be able to use a self-directed IRA, which goes directly to what you said about how to get more funds if you're not. That's another option. So it's doable. Even with the problem with the turnkey, not the auction. Okay, when you buy a rental property, when it's less than 60,000, the banks would not want to finance it. So it's a cash, or sometimes we're able to get attractive private seller. Okay, attractive meaning better rates, not the typical 12% or so. Yes? Yes?
In this example, 4 months seems like a long hold period. What would you say is a hold period for a typical?
So 4 months seems a long term. Let me explain to you why it can be take so long. Let's say the work is 2 to 3 weeks. So that's not even a month. Why does it take so long?
It takes a month to buy the place.
No. Come back to auction. You got it. You are the owner the next day. Let's take an example. You bought it today. Tomorrow you're the owner. They're going to take recording.
Is it because people have to qualify for finance?
No. Yes, that's part of it. So first of all, assuming nobody lives in this house, if someone lives in this house, which happens, you either walk up to them normally and you give them a little bit, like $1,000 or $500 to leave. Okay, people do that. You're not going to do it. You're here. They're not going to do it. Okay. Assuming we want to keep them. Assuming we don't want to make it a rental, right? Assuming we want to do a fix and flip. Now, if they're not willing, we need to file for eviction. That takes a few $100, $300-400, it may take 2 to 3 weeks. Okay, typically. Sometimes if it's a long line, maybe 4 weeks. So that may take some time. Let's say that's not always the case. So you buy a property, it's vacant, you practically can start the morning after work. But you need a few days, never mind, you need a few days to get together. The house is ready, let's say a month later, the house is ready. Why the 3 other more months? Well, on average, until a buyer comes in, until a buyer qualifies, something happens, it takes time to closing. It's mostly on the end buyer, time spent qualifying, purchasing, and completing that transaction. That's it. Mostly it's a wait time.
So is that 2 to 3 months a accelerated sales period and a typical sale? You said your team will sell houses quicker because they take the next.
Yeah, those guys in the last 2 to 3 transactions, not including this one, I think they had 5 days, took them to get an offer and accepted it. And the one before that, 6 days. For a reason. If you go there and spend the day seeing properties, you will see What I'm talking about, it's actually not typical what they do. They're taking it a little bit extra. Not crazy, but enough to make it more attractive.
So even with that advantage, it will take up to 3-4 months.
Yes, because buyers, it takes them time to qualify and get the loan and close. That's the problem. Okay, 2 months easily. So right there, you get 3 months right there. What if it takes a little bit, a week there, there's a little bit delay? You hit 4 months without, blinking, I should say. Doesn't mean it's on average. We had 2 months, we had 3 months, but we had 6. So just to give you, again, realistic, not to beautify anything. Yes?
Okay, so maybe I should just say something, because I've heard you here. I am one of those wholesale turnkey people. I don't work in your state of Atlanta, so I'm not sure about it, and I have different states. My states are Oklahoma, Kansas, and Missouri, and very fine. And you can do self-directed IRAs, etc. All I want to say, repeat what he said, which is this is a perfect time to get into this real estate business. Really, whether you do it, in Phoenix, Atlanta, or wherever you go, this is really a great opportunity to get into it. These flippers are okay. I mean, you don't have to do the big flippers. If you actually want to physically go to Atlanta, maybe see something, you don't, what we were taught is don't get greedy. If you can make $15,000, that's fine. But if you can make more than that and you're doing this, go ahead and do it. If you want to invest in it and buy it, go ahead and do it. But this is really a good time. I'm a year late in the business where I am, and the properties where I'm selling are between, they're around what now? They're about 35 to 45. Well, last year they were selling for 22 and 25. And they're already gone up.
Yeah.
So you really, if y'all want to do it, get into it. Because, and like you said, fear is a big factor. Sometimes doing something that you don't know about, it's out of state, because unfortunately we can't do this in California, because I looked.
By the way, one of the reasons I don't like California? In California, the eviction laws are not very favoring the landlord. In those states, they do it.
Right.
You can easily, I'm not talking about San Francisco, even in the less strict counties, you can easily waste or lose, a year worth of profits of, cash flow on one eviction. Not to mention the suffering, the anxiety, and so on. I had an eviction in Dallas many years ago. 2.5 weeks, $242, and they were gone. Okay? By the way, I didn't do anything. Property manager did, but I paid the 200. By the way, the deposit paid for the, for the eviction, not me. So, and I did an eviction in Florida last year. By the way, myself over the phone, spoke to the sheriff, spoke to a guy that wanted to put the notice, all myself without a property manager on the phone. It took 10 days. Actually, it was expensive. It was $670, 10 days. And the evicted person signed a new agreement to move back in. I put up the terms. I said, you behaved badly. You tested me. That was wrong for you to do. I was nice to you. You actually abused me. Here are the new terms. You want to move back in. Rent stays the same. Month and a half deposit. And you pay everything I spend. The minute you have that, the keys waiting for you at the locksmith's office. And he did. It took him 2 days to get the money, and he did. And everything was fine. But from that point on, by the way, he didn't play games with me anymore. Because at the beginning, he kind of tested me, like a little child. Ain't gonna happen.
And honestly, if you buy some of those houses in the other states, and not here in California or some of the other places, you can probably get your $10,000 per month in maybe 5 years. It's just how much effort you're going to put into it.
Right. Any other questions? Yes. Card. When I'm done, I'll pull it from my, yeah, okay. Oh, okay. Any other questions? Yes.
Have you ever had a situation where investor put money your team couldn't make profit out of it?
Can you repeat that?
Have you ever had a situation investor put money into the deal, your team couldn't make a profit out of it?
They had one situation where they made, the total profit was $4,000, total. So, sorry about that. $4,000. Losing? No. Nice? No. But close, at least we didn't lose. So it's possible. And they made some mistakes, and they admit that.